Hi there, welcome to this weekly general update for the 23rd of September. And we're seeing some pretty interesting movements over the last few weeks since the actions of the Federal Reserve. But look, last week was probably flat, bit of a consolidation week for stocks and commodities. But the trends are still pretty much in the upwards direction at the moment. So just a reminder about the general advice nature of this video. So quick summary of the week, the S&P index ended up lower by 5 points on the week, but as we'll see from some of the charts, the small caps, the Russell 2000 index is still as resilient as ever, and that's a really good sign for the market. If the market was being held up purely by the top 10 or 20 names in the Dow Jones, then we'd see the Russell a lot weaker than it is. So a lot of these people that are the doom and gloom merchants that are pointing to more downside, they just really want to take a look at all the indicators, and certainly the Russell looking pretty resilient at the moment. The S&P index, as we'll see, is still trending higher, although it has been consolidating, and I wouldn't be surprised if we saw a little bit more downside over the next week or so, but look, I don't think it's going to be of any real significance. Now in Australia, our index, for what it's worth, because really looking at our index is really not giving you a very good indication of what's happening on our market. It's basically what the BHP and the banks are doing, and money is just rotating out of one sector into the other, and so net the index is really not moving that much at all. But just for the record, our index rose 18 points. But you've really got to get down to a stock specific level to understand what's going on. Now importantly, the US dollar was slightly higher on the week. As expected, it had been sold down very heavily for 3 or 4 weeks in a row, so to get a bit of a rebound is perfectly normal. It had got terribly oversold, as we'll see, but you'd have to say, given the severity of the falls in the month before, that the direction is still to the downside. Now bond yields in Europe continue to ease, which is a good sign for financial markets. The Spanish yield, which you remember was up above 7% at the height of the crisis, now down to about 5.76. Still not great, but at least it's heading in the right direction. And the Italian yield is getting down and looking like it might possibly move under 5%. So very positive there. Let's have a look at a few charts then. We'll start with the US dollar index, and let's have a look at this on a weekly basis just to give us a bit of a wider view. So you can see we had 4 very strong weeks down. We broke through support and quite a sharp move. Now to get a couple of smaller range weeks to the upside would be pretty normal. So you can see this is a big picture. We're in this big picture triangle that's been forming now since I've got to go really back to about 2005. So at the moment that fall has been so relatively sharp. You can see other times back here in June of 2010 when we get that sharp move, we get a bit of a rebound, and then the move continues all the way to the bottom, and I think we're going to see the same thing happen this time, and that will be net positive for commodities and for stocks. However, as far as Australian commodity stocks go, you've got to remember that we've got this added influence of what's happening in China. So it's not as simple as just looking at the American market for us. Let's have a look at the S&P index. This is on a daily chart. We've gotten to a peak at the moment of 1474. There's probably resistance up around about the 1495 to 1500 mark, and of course we've got the all-time highs up here at around 1570, 1580. Just looking at the normal retracement structure, pulling back to 1445 would make sense. On Thursday night it pulled back to 1449, basically 1450. But at the moment you've got to say it's still up, and we haven't really had much of a retracement. We still might get a little bit more downside yet in the coming week, but you'd have to say that this market looks like it's going to have a crack at 1500 in the quite near term. Now, as I mentioned, let's have a look at the Russell Index, Russell 2000. We're almost basically at all-time highs, and it's quite amazing, the strength, and you can see just how much how strong this uptrend has been in the last few months. So another good indicator of the momentum behind the US market. Let's have a look at their banking sector. Again, this is not, it's basically at yeah, it's at all-time highs as far as this particular index is concerned, and you've got to say that's still trending in the upwards direction. Now, of more concern for us is what's happening in China, and this is the Shanghai Composite Index, and this really is a bit of a worry. You can see here we've got a support line that looks like it's probably been broken. It's not really definitive yet, but it's certainly not a good sign. Now, it's getting down to oversold, but I thought when we had this little push up here 2 weeks ago that we may have found a base and would start to head higher, because as you can see, we broke a short-term downtrend line, but it's immediately turned around and fallen over again, which is not great. Now, there's some discussion that it was due to the tensions with Japan, but frankly I don't buy that at all. I think it's just more concern about this policy vacuum that we've got in China at the moment while the leadership changes, and no one's really sure how things are going to play out. So that's not particularly healthy for our market, I must say. Let's look at the level of fear in the US market. It's incredibly low. This is a VIX index. We're now down into the 12s again, and you can see this is as low as it's been. We've really got to go back to May of 2008. So we've got to go back before the GFC to see levels of calm and if you like, complacency in the market. There's two ways to read that. That is that nobody's worried, and therefore we shouldn't be, or you could look at it and say, well, there's such a high level of complacency that maybe we're near some kind of turning point. We'll know in due course. Now let's have a look at our index just for the record. It's just nudging up a little bit, but as I said, it's really being held back by the fact that money is not really flowing into our market. It's really just money's moving out of one sector and into another. But if we look at the actual individual sectors themselves, you can see there's been a pretty good recovery in materials just in the last week, last few weeks I should say, but it's really just correcting a fairly major downtrend. This is the small caps in our market, which really have started to do quite well in the last month or two. There's quite a strong trend happening there. Healthcare has been a very consistent performer. There's a good solid trend going on there. Obviously finance, there was a very substantial move up in the banks, and that was really the only thing that held our index together. But you can see it's really, the banking sector's really done very little since early August. And energy, pretty similar, hasn't really done a great deal in the last month or so. So that's all of our particular market. Now looking at gold, obviously gold's on an absolute tear at the moment. On a big picture view, it did finish flat on the week and touched resistance up at 1785, as we'll see. So you've really got to expect a bit of a pullback in gold and perhaps a bit of a pause in the gold stocks. But we're now seeing the stocks actually outperform, gold stocks outperforming the metal on a global basis. And that's something that's been long overdue, and I've been talking about for probably a year or more, the fact that that anomaly would turn around. Silver, look, it's the same story as gold. The trend is even stronger than with gold, which is exactly what you would expect. The silver market is much, much smaller than gold, and therefore any significant moves into that sector are going to see an outperformance in the price. Copper still doing very well, $3.76, and for all the people who want to tell you how bad the global economy is and how the price of copper is going to crash, um, it's just guesswork on their part or wishful thinking. I don't know what it is, but it's certainly not being reflected in the charts. Now oil declined $6 on the week to $93. From what I read, it's probably just blatant, overt manipulation. The US government would certainly want to have energy prices lower pre the election, and it really should be an absolute scandal the way that financial markets are manipulated these days for political purposes, but nobody's saying too much, it would seem. This is the spot copper chart for 6 months, and the all-time highs are just a tick over $4 a pound. We're around the 380 mark. I can't see there why the price of copper is going to crash, as some people are predicting. So we'll just touch on the strategy before we go back and look at some of those final charts. Basically, this is the same as last week. It's buying the dips. The trends are up. You want to buy the dips. We should get a correction short term. We've had a pretty good run, and obviously a focus on gold, and particularly in the small cap area. So not a lot of changes there. Now let's have a look at the gold chart. We'll look at it first of all on a weekly basis. So you can see here we've pushed up to almost exactly a medium-term double top. This the same as the level we were at in March of 2012. And so to expect a bit of a pullback to maybe 1700 to 1720 would be perfectly normal. However, you can see the RSI on gold is not yet overbought, so potentially there's still some upside, and it could push through here and potentially head straight to $19. I doubt it. Markets just don't tend to go that way, but it's possible. Let's look at it on a weekly basis. You can see we've just had a consolidation over the last week. Not a lot of net movement there. And silver also just consolidated over the last week. Let's have a look at the HUI index, and this has been on a real tear. You can see a terrific strong trend over, we've got to go back to mid-July, so it's about the last 2 months. Gold stocks have really outperformed, and let's have a look at this on a relative comparison basis. So this is going back 12 months. So the green line at the top is the US dollar price of gold, and the blue line at the bottom is the HUI index, which is probably the most recognized gold index around the world. And you can see there was a huge deviation that really started probably about 8 months ago, and we saw stocks way down here in May significantly underperforming the price of gold, but you can see now that gap is closing very rapidly. So gold stocks really playing catch up to the price of gold, and I would expect this blue line to cross over the green line, and that's why we're seeing such a good move in gold at the moment. So that's it for this week. I think we can probably look forward to some sort of consolidation or correction in the short term, but to me the trends probably certainly through to the end of the year and possibly into the first quarter of next year still look pretty robust. So just focus on buying the dips, and we'll see you again next weekend. Cheers.